Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HUA HONG Semiconductor Limited annual report. HUA HONG Semiconductor Limited offers a diverse range of semiconductor products and services to various industries worldwide. At its core, the company manufactures and sells embedded non-volatile memory, standalone non-volatile memory, power discrete devices, analog and power management platforms, specialty logic RF processes, and image sensors. In addition to product manufacturing, HUA HONG Semiconductor provides design services that cater to a wide range of needs. These include design methodologies and flow support, standard and customized Internet protocol development, ASIC design, and one-stop services. The company also offers multi-project wafer services, mask marking services, back-end testing, mass production, product engineering, and backside processing services. Furthermore, HUA HONG Semiconductor engages in real estate development and trading activities, expanding its business scope beyond semiconductor products and services. Its products are utilized in various applications such as consumer electronics, industrial control, automotive electronics, Internet of Things, and communications and computers. With a presence in China, North America, Asia, and Europe, the company has established itself as a global player in the semiconductor industry. HUA HONG Semiconductor Limited market capitalization of $167 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that HUA HONG Semiconductor Limited holds a significant advantage in their industry. HUA HONG Semiconductor Limited trades at a higher price-to-book ratio of 2.78 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 28% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. The rapid development of artificial intelligence and edge applications has been a significant contributor to revenue growth. Additionally, the fast growth in high-performance computing chip and memory chip markets has also played a crucial role. Furthermore, the steady recovery in the mature process chip market and the swift increase in revenue contribution from 12-inch wafers due to capacity ramp-up of HUA HONG manufacturing project have been major drivers. The company's satisfactory results across major specialty technology platforms, such as analog and power management, embedded non-volatile memory, and standalone non-volatile memory, have also contributed to revenue growth. The strong demand for these platforms in various industries, including consumer electronics, automotive electronics, and energy solutions, has driven revenue growth. In terms of specific regions, China has seen a 20.6% year-on-year increase in revenue, while analog and power management has experienced a 41.4% year-on-year increase. Embedded non-volatile memory and standalone non-volatile memory have also seen significant growth, with increases of 16.2% and 44.2%, respectively. On the other hand, there are no specific drivers mentioned for revenue decline in the provided text. However, Europe has experienced a -2.6% year-on-year decrease in revenue. Additionally, chronic physical risks such as persistent high temperature, whether caused by climate change, have been identified as a potential risk to revenue growth. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, there was a decrease from $58.1 million to $54.9 million in 2024. However, the following year saw an increase of $16.1 million, bringing the net income back up. The exact nature of the change mentioned on page 304 is unclear, as it refers to a decrease of $2,077 million, without specifying whether this is a percentage or absolute value. The profit margins also experienced a decline between 2023 and 2024, dropping from 18% to 11.8%. Although there was an increase in 2025, the margin only rose by 0.2%, indicating that the company still struggled with profitability. The reasons behind this decline were attributed to decreased revenue growth rate, reduced gross profit margins, and a complex impairment test process. The company's financial performance indicates a strong ability to generate cash from its core operations. The data shows that net cash flows from operating activities are consistently positive across various reports. In 2025, the company generated $649,992 in net cash flows from operating activities, page 317, which is a significant indicator of its operational efficiency. Additionally, the net operating cash flow for 2025 was reported to be $4,750,476, page 313. These figures demonstrate that the company's core business is generating substantial amounts of cash, allowing it to sustain its operations and invest in growth initiatives. The positive trend continues when examining other reports. On page 429, net cash flows from operating activities were recorded at $470,669 for 2025. Furthermore, the net carry amount, which represents the residual value of cash generated from operations after accounting for non-cash items, was reported to be $282,053 in 2025, page 389. This suggests that the company's operational performance is not only generating positive cash flows, but also maintaining a healthy level of liquidity. In conclusion, the data clearly indicates that the company is generating positive operating cash flow. The consistent and substantial amounts of net cash flows from operating activities across various reports demonstrate the company's ability to manage its core operations efficiently and generate significant cash inflows. This is a strong indicator of the company's financial health and sustainability. The performance of various segments and regions has been analyzed based on the extracted summaries. In terms of revenue growth, some regions have shown significant improvement, while others have experienced a decline. The Chinese mainland and Hong Kong have emerged as top performers, with a substantial increase in revenue from $1,636,528 in 2024 to $1,974,098 in 2025. This represents a notable growth of over 20%. Similarly, Asia, excluding the Chinese mainland and Hong Kong, has also seen a slight increase in revenue, albeit at a slower pace. On the other hand, North America and Europe have struggled with declining revenues. In North America, revenue decreased from $187,899 in 2024 to $246,091 in 2025, indicating a significant drop of over 30%. Europe has also experienced a decline, although less pronounced, with revenue decreasing from $69,528 in 2024 to $67,724 in 2025. Management is optimistic about the company's outlook, highlighting several key initiatives and strategies that will drive growth and success. In the short term, management aims to complete several critical projects by the end of 2026, including the HUA Hong Manufacturing Project and the Specialty Technological Innovation Project. These efforts are expected to upgrade and modernize the company's production lines, driving efficiency and competitiveness. Looking ahead, management is focused on building a knowledge-based workforce through a systematic talent development system. This will enable the company to drive innovation-driven growth and stay at the forefront of industry trends. Additionally, management is prioritizing employee well-being and development, with initiatives aimed at creating a positive work environment and supporting employees' practical needs. In terms of long-term strategy, management is committed to fostering a cohesive workforce through tiered talent development and innovation-driven growth. The company will also prioritize investments in climate-friendly technologies and eco-friendly products as part of its ESG, environmental, social, and governance strategy. By setting industry benchmarks through its academician workstation and focusing on technological innovation and upgrading, management is confident that the company will emerge as a leader in its field. Overall, management's outlook is one of optimism and growth, driven by a commitment to innovation, employee development, and sustainability. The company has demonstrated its commitment to returning value to shareholders through various means. In the year ended 31 December 2024, it paid dividends and bought back shares, totaling $1,215 USD. This indicates a proactive approach to rewarding investors for their loyalty. However, in the subsequent year, the company's strategy shifted slightly. Despite buying back shares worth $11,446 USD, it chose not to pay dividends. This decision may have been driven by a desire to conserve cash or allocate resources towards other priorities. Nonetheless, the fact that share buybacks continued suggests that the company remains committed to enhancing shareholder value through alternative means. Overall, the company's actions demonstrate a nuanced approach to dividend payments and share buybacks. While it has paid dividends in the past, its decision not to do so in 2025 highlights the importance of flexibility in corporate strategy. Concerns about inventory buildup and supply chain disruption are evident in the company's operations. On page 83, sustainable supply chain management is highlighted as a topic with double materiality, indicating its importance in both financial and non-financial aspects. This emphasis on sustainability raises concerns that meeting environmental and social responsibility standards may lead to potential disruptions in the supply chain. Furthermore, page 88 notes the risk of supply chain instability due to diversifying suppliers, which could impact profitability and competitive advantage. This suggests that the company's efforts to meet sustainability goals are putting pressure on its supply chain, potentially leading to inventory buildup or disruption. The data on inventory levels from page 388 confirms these concerns. A significant increase in raw materials, 15.5%, work in progress, 27.3%, and finished goods, 90.6%, from 2024 to 2025 indicates a potential buildup of inventory. This accumulation could lead to cash flow problems, reduced flexibility, and increased costs for the company. The combination of these factors raises serious concerns about the long-term sustainability of the company's operations. That concludes the financial summary for HUA Hong Semiconductor Limited. Feel free to comment below, and I will be happy to answer them when possible.